China's $326 trillion in foreign reserves as of December 7, 2024, is more than just an impressive number. It's a financial superpower that shapes global markets, influences geopolitics, and protects the stability of its economy. But how did China manage to amass such a staggering amount of wealth, outpacing every other country in the world? This isn't just about money in a vault. It's a strategic tool that's reshaping the global economic order. Today, we're diving into the heart of this financial phenomenon to uncover the secrets behind China's massive foreign reserves. Think of it this way: $326 trillion could buy every single Apple product ever sold, twice over. But China doesn't use this treasure trove the way you might think. It's not about luxury or extravagance. It's about power, security, and influence. These reserves serve as a financial shield during crises, a tool for stabilizing the yuan, and even a way to influence other nations' economies. So, why does China hold this much, and how does it all work? Stay with us as we unravel these mysteries, explain how these reserves impact the world, and explore what it all means for you. If you're ready for a deep dive into one of the most intriguing stories in global finance, like, share, and subscribe to Economy Explorer. And don't skip a second of this video. What are foreign reserves? Think about this. If a country were a household, foreign reserves would be its emergency savings account, a crucial buffer against financial uncertainty. But unlike regular savings, these reserves are not just tucked away in a bank. They're intricately tied to a nation's global standing and economic strategy. Foreign reserves represent a nation's financial muscle, stored in the form of foreign currencies, gold, and other liquid assets, and they play a vital role in stabilizing economies and maintaining international trade. The concept might sound abstract, but its impact is anything but. At their core, foreign reserves are the assets held by a country's central bank. These reserves are typically denominated in foreign currencies like the US dollar, the euro, or the Japanese yen, making them valuable for conducting international trade. For instance, when a country needs to import oil or pay off foreign debts, foreign reserves act as a readily available payment method. But their significance goes far beyond mere transactions. These reserves also serve as a safety net during times of economic turbulence, allowing governments to stabilize their currency and maintain investor confidence. The idea of holding foreign reserves isn't new. Historically, nations began stockpiling gold and foreign currencies as early as the 19th century to protect their economies from unpredictable global markets. Over time, this practice evolved, and today, foreign reserves include a mix of gold, cash, and even government bonds. This diversification ensures a nation's wealth remains secure, even when markets fluctuate. Think of it as an insurance policy against the unpredictable tides of global finance. Here's where it gets fascinating. The size of a country's foreign reserves is often seen as a measure of its economic stability and influence. Nations like China, with their massive $326 trillion reserves, wield incredible financial power, shaping global trade and financial systems. But why does size matter so much? And how do countries decide how much to hold? Stay with us as we explore these questions and uncover the secrets behind China's extraordinary reserve strategy. How did China accumulate such massive reserves? The story of China's colossal foreign reserves begins with its transformation into the world's factory. In the late 20th century, China embarked on a journey of unprecedented economic reform, opening its doors to global trade and investment. The turning point came in 2001 when China joined the World Trade Organization, WTO, cementing its role as a global manufacturing powerhouse. Suddenly, goods stamped "Made in China" began flooding markets worldwide. This surge in exports laid the foundation for the steady accumulation of foreign reserves, a trend that has continued for decades. Here's how it works. When countries like the United States import products from China, they pay in US dollars or other foreign currencies. Instead of allowing these foreign earnings to circulate freely, the Chinese government requires businesses to convert them into yuan through the central bank. This system ensures a consistent inflow of foreign currencies into China's reserve stockpile. Over time, these inflows from trade surpluses have grown into the trillions, creating one of the largest reserve holdings in the world. But trade is just the beginning. Another key driver behind China's reserve accumulation is its strict control over the yuan's exchange rate. Unlike freely floating currencies, the yuan's value is tightly managed to remain competitive in global markets. To prevent the yuan from appreciating too quickly due to large inflows of foreign currencies, the Chinese central bank buys US dollars and other currencies, adding them to its reserves. This strategy ensures that Chinese exports remain attractively priced, further boosting trade and, consequently, reserves. Foreign direct investment, FDI, is another factor fueling China's reserves. Over the years, international companies have poured billions into China, drawn by its skilled labor force, vast consumer market, and favorable policies. These investments bring in more foreign currency, further augmenting reserves. And let's not forget China's overseas earnings from investments in foreign bonds, equities, and businesses. These too contribute significantly to its reserve stockpile. What makes China's reserve accumulation truly remarkable is the speed and scale of its growth. For context, China's reserves were just $150 billion in 1996. Fast forward to today, and they've ballooned to $326 trillion. But here's the question that economists and policymakers have debated for years. Is there such a thing as too much when it comes to foreign reserves? And what happens when reserves reach this level of dominance? The answers lie in how China uses this financial clout, which we'll explore next. How does China use its reserves? When you think about $326 trillion, it's hard to wrap your mind around how a country even begins to manage and utilize such a vast sum of money. But China has developed a sophisticated strategy that leverages these reserves to safeguard its economy, strengthen its global influence, and prepare for uncertainties. Every dollar, ounce of gold, and bond in these reserves serves a specific purpose, turning this stockpile into one of China's most powerful tools. One of the most prominent uses of China's reserves is in holding U.S. Treasury securities. By lending money to the U.S. government through Treasury bonds, China not only earns interest, but also secures its reserves in one of the safest investment vehicles in the world. As of the latest data, China is the second largest foreign holder of U.S. debt, with over $770 billion invested. This relationship ties the economies of the two superpowers together, creating a financial interdependence that benefits both. But here's the kicker. By holding such significant amounts of U.S. debt, China gains leverage in global financial discussions, a subtle yet potent form of economic diplomacy. Another critical function of China's reserves is stabilizing the yuan. When global markets fluctuate or external economic shocks threaten China's financial stability, the People's Bank of China steps in. By buying or selling foreign currencies, the central bank can influence the exchange rate, keeping the yuan at a level that supports exports while minimizing inflation. This careful balance ensures China remains competitive in global trade, protecting its position as the world's largest exporter. China also uses its reserves to support its Belt and Road Initiative, BRI. Through this ambitious infrastructure and investment program, China has extended loans and funding to developing countries across Asia, Africa, and Europe. By deploying reserves in this way, China not only secures new trade routes and resources, but also expands its geopolitical influence. These investments are a win-win. They help other nations develop while solidifying China's economic and political ties with them. And then there's gold. Over the years, China has steadily increased its gold reserves, signaling a shift toward diversification and reducing reliance on the U.S. dollar. Gold is a hedge against currency fluctuations and economic instability, making it an essential part of China's long-term strategy. But here's the fascinating part. Managing these reserves isn't just about maintaining economic stability. It's about preparing for a future where financial dominance will play a pivotal role in shaping global power dynamics. The decisions China makes with its reserves today could have ripple effects across the world for decades to come. What challenges might this strategy face, and how could it reshape global markets? Stay tuned as we unravel the answers in the next segment. Challenges and future implications. Holding $326 trillion in foreign reserves might seem like an unshakable advantage, but even this financial fortress faces vulnerabilities. One of the biggest challenges is China's heavy reliance on U.S. assets, particularly Treasury bonds. While these investments are considered safe, they tether China's financial fate to U.S. monetary policies and geopolitical decisions, creating potential risks. Any significant policy shift or geopolitical tension could erode the value of these reserves, threatening economic stability. Additionally, the shrinking returns on low-yield assets pose a dilemma. Critics argue that a portion of these reserves could be redirected toward domestic development to fuel economic growth. But doing so risks undermining the safety net these reserves provide. Striking this balance is a critical challenge for China's policymakers. Meanwhile, the global economic landscape is shifting. With rising labor costs and supply chains moving to countries like Vietnam and India, China's trade surplus, the main driver of its reserve growth, faces mounting pressure. Combined with increasing calls to reduce dollar dominance and the rise of alternative currencies, the path ahead is uncertain. These challenges are not just financial, they're strategic. How China adapts to these pressures will determine not only its economic trajectory, but also its influence in shaping the global financial system. China's reserves are a symbol of power, but they are also a test of resilience. If you enjoyed this deep dive, like, share, and subscribe to Economy Explorer. Watch one of the videos on screen to continue exploring the fascinating world of global finance. Thank you for being part of our journey. See you next time.